When you take a loan from a bank, where do you think the money comes from? Most people assume that the bank gives you the money it already has, right? And maybe money from other people's savings, maybe money it has set aside. That assumption feels natural, and it's how most of us imagine banking works. But that assumption is wrong. And once you see what actually happens, it completely changes the way you see debt. Here's the common picture most of us have in our heads. People deposit money into a bank. The bank keeps some of it, and then it lends the rest out. That makes sense, right? And to be fair, that used to be closer to how people describe banking. So if you've believed in this, you're not naive, by the way. It's a reasonable assumption. But here's what actually happens today. When a bank approves your loan, it doesn't take an existing money from someone else and hand it to you. Instead, two things happen at the same time. First, the bank adds money to your account, which just means it writes a number there that you're now allowed to spend. You suddenly see money there that wasn't there before. Second, the bank writes down that you owe it that amount back, plus more later. That written obligation is valuable to the bank because it means you're required to repay. Nothing moved from another person's account to yours. The money didn't come from someone else. It was created at that moment. Let's slow that down because that is the key idea. When your loan is approved, the bank creates a number in your account that you can spend and a promise attached to you that you must repay later. The spending power and the debt are created together. One cannot exist without the other. Now, this is usually where people get uncomfortable. So let me be very clear. This doesn't mean banks can create unlimited money whenever they want. Banks are constrained, they face rules, they have limits on how much risk that they can take. They're overseen by central banks, which exist to supervise the system. And all of that is real. But the key limit is not that the banks need to already have the money first. The limit is about rules and risk, not about a pile of cash waiting in the vault. And that distinction matters, by the way. So let's talk about why this matters to you. If money is created when loans are created, then ask yourself this: what must always exist alongside money? Debt, right? And if every new unit of money enters the system as debt, then over time, what must keep growing? Borrowing, right? This is why debt doesn't feel like an exception anymore. It feels normal. Mortgages, student loans, business loans, credit cards, even governments operate this way. So debt isn't a failure of discipline. It's built into how the money enters the system. Now, think about what that does to behavior. If money enters system through debt, then someone always owes more than they received. Extra payments are required on top of what was created. And the system depends on continuous borrowing to keep going. And that creates pressure. Pressure on individuals, pressure on businesses, pressure on the entire economies to keep growing. That is why so many people feel trapped in cycles they don't consciously choose. You're not borrowing because you love debt, right? You're borrowing because the system is designed around it. And over time, that design shapes how much risk you feel forced to take, how fast you feel you must grow, and how difficult it is to slow down. Now, bring this back to the purpose of money. If money is supposed to store value over time, creating it as a debt changes that relationship completely. Instead of being a neutral tool, money becomes an obligation. And instead of carrying past effort into the future, it pulls future effort into the present. And that shift is subtle but profound. So let me leave you with a real question. If money is created when debt is created, then the real issue isn't why people borrow so much. It's this: why does the system require debt in order to function at all? Assalamu alaikum. If you're new here, my name is Parama. And alhamdulillah, I've been financially free for many years now. At this stage of my life, I'm more interested in helping others build prosperity as well. But inshallah, in a way that is halal and sustainable. Over time, I developed a step-by-step framework for halal prosperity so people can build a successful life in this world and inshallah aim for sadaqah jariyah, which is an ongoing deeds that continue to benefit others even after they're gone. I presented this framework at the World Bank in Washington, D.C. At its core, the framework is pretty simple, actually. First, learn how to protect your wealth, then grow it responsibly, and finally, distribute that wealth in ways that create lasting legacy and benefit. This channel is where I walk through that framework step by step. We start from the foundation of how money actually works, then move into protecting wealth first, then creating wealth responsibly, and eventually how that prosperity can support others, endure over time, and contribute to a life that balances deen and dunya. If this way of thinking about money and prosperity resonates with you, you're in the right place.